Hey everyone, welcome back to Corporate Decoder. Today, Mingteng International Corporation Inc., ticker MTEN, just filed an F-1 registration statement signaling a potential new offering, and I am seeing some serious red flags around their financials. Quick note, this is not financial advice, just my take on public filings for educational purposes. After a recent sharp stock price drop, this filing shows a company in a tight financial spot with significant risks related to its China operations. Alright, let's dive into this F-1 filing from Mingteng International Corporation Inc. This is essentially a registration statement to sell securities, and in this case it is for the resale of a lot of Class A ordinary shares by existing shareholders. This means the company itself isn't raising new money directly from this particular sale. But the shareholders who got these shares through various private placements and warrant exercises are now looking to sell them to the public. So we are talking about a lot of shares here. Up to 2,280,000 Class A ordinary shares from a previous private investment deal. Another 148,000 shares that can be issued if people exercise their investor warrants, and an additional 111,000 shares from warrants given to the placement agent. That is a total of over 3.8 million shares potentially hitting the market. The company itself, Mingteng International Corporation Inc., is incorporated in the Cayman Islands, but its actual business is in China, specifically in Wuxi. They're in the business of developing and supplying automotive molds. Think of the metal molds that are used to stamp out car parts. This dual structure, being a Cayman Islands company with operations in China, is a common setup, but it comes with a whole host of unique risks, and the filing really hammers this point home right from the get-go. They put this in big bold letters for a reason. Folks, investing in their shares is considered a high-risk proposition. They're talking about risks related to doing business in China, which includes uncertainties about Chinese laws and regulations, and the potential for governmental interference. This is a huge factor for any company operating in China and listed in the US. This is a critical risk. The Holding Foreign Companies Accountable Act, or HFCAA, could lead to the delisting of their stock from US exchanges if the Public Company Accounting Oversight Board, or PCAOB, cannot inspect their auditors for a certain number of years. This has been a recurring issue for many China-based companies listed in the US, and it introduces significant uncertainty for investors. The number of years has even been reduced, increasing that risk. Then there is the uncertainty around China's foreign investment law. The rules keep changing, and it is unclear how these changes will affect the company's structure, how it is run, and its actual business operations. This regulatory environment is a minefield, and any misstep could be very costly. Let's jump into the financials for the last couple of years. For the year ended the 31st of December 2025, their total revenue was about $11.66 million, which was an increase from $10.12 million in 2024. That is a positive sign showing some revenue growth. But here is where it gets concerning. The cost of revenue jumped significantly. In 2025, it was over $9 million, up from about $7 million in 2024. This means their costs went up much faster than their revenues. As a result, their gross profit actually decreased. In 2025, it was around $2.6 million, down from $3.06 million in 2024. Their gross profit margin also took a hit, shrinking to 22.5% in 2025 from 30.3% in 2024. This tells us they are making less profit on each dollar of sales. However, there is a huge positive here in general and administrative expenses. They dropped dramatically from over $7.3 million in 2024 to about $2.1 million in 2025. This massive decrease is largely attributed to a significant reduction in liabilities related to share-based compensation and personal income tax, and lower consulting fees compared to the IPO year. This is a major positive operational improvement. Despite the revenue growth and reduced GAA, the company still reported a net loss. In 2025, the net loss was about $1.78 million, a big improvement from a loss of nearly $5.7 million in 2024. So, they are losing less money, but still losing money. Looking at liquidity, their cash and cash equivalents decreased from about $2.08 million at the end of 2024 to $1.45 million at the end of 2025. This is a concerning trend, especially given the potential for increased costs and operational challenges. And here is a really interesting item in their assets, a prepayment for acquisition-related deposit of almost $15.2 million in 2025. This means they've put down a substantial amount of money, likely for potential acquisitions that are still in progress. This ties up a lot of their capital. They also have ongoing transactions with related parties, like purchases from Wuxi Kaitang Mold Factory. While these are common in business, it is always something worth keeping an eye on for potential conflicts of interest or favorable terms. When we look at ownership, Ying Kai-shu, the CEO, along with entities he controls like Waixu Holding Limited, holds a significant chunk of voting power, especially with the Class B shares. These Class B shares have 200 votes per share compared to just 1 vote per class of share. This means management holds a substantial amount of control, which is typical but also concentrates power. Now back to these selling shareholders. It is important to remember that these are shares previously issued in private deals. The fact that investors are now looking to sell through this filing suggests they might be looking to exit, which can sometimes put downward pressure on the stock price if there is a large volume for sale. Digging into the background, the company experienced a 1 for -200 reverse stock split in January 2026. This is often done to boost a low stock price, but historically, many companies that do such extreme reverse splits struggle afterward. For instance, Kodak did a similar reverse split in 2021, and its stock later saw significant declines. About half of microcap companies that do reverse splits end up delisted. For MTEN, a $1,000 investment before such splits could have seen its value drop drastically. Overall, the story here is one of a company with a core business in China under significant regulatory and economic pressure. While they've shown some revenue growth and reduced losses, the increasing cost of revenue, significant debt from loans, and concerns about China's regulatory landscape are major risks. The large amount of shares being potentially sold by existing shareholders adds another layer of risk for new investors. The research tools I use are linked in the description. They help keep this channel going. Like, comment, subscribe, and join the Discord linked in description.